Could 2 tech stocks you already know become your best buys this October? In a market that never sleeps, where fortunes are made and lost with the blink of an eye, opportunities arise for those who are paying close attention. Today, we are not talking about obscure startups or high-risk penny stocks that promise the moon, but often deliver nothing. Instead, we are focusing our analytical lens on 2 bona fide titans of the technology industry, household names that have already shaped our digital world and are now positioning themselves for their next major phase of growth and dominance. If you only watch one video today, make sure you watch this one, all the way till the end. We are diving deep into 2 specific companies that command immense influence in their respective domains. One is an undisputed leader in enterprise software, a giant that powers the back-end operations of the world's largest corporations and has quietly yet powerfully built a formidable presence in the lucrative cloud computing arena. The other is a pioneer in social technology, a behemoth in digital advertising that connects billions of people, and is now aggressively investing in the next frontier of human interaction. Both of these companies are at critical inflection points, making strategic moves right now that could unlock significant upside for investors who act with conviction. We will cut through the noise and the jargon that so often complicates financial discussions. We will present a straightforward, fact-based case for why each of these stocks deserves a prime spot on your watch list as we head into the final quarter of the year. We'll use simple ideas and clear data to show why the time to consider these giants is not next year or next month, but right now. The market is a forward-looking mechanism, constantly trying to price in what will happen 6 to 12 months from now. That means the seeds of tomorrow's biggest winners are being planted today. If you only watch one video today, make sure you watch this one to the end. Hit like, let's get 1,000 likes on this one, share it, leave your thoughts in the comments, and subscribe so you don't miss the next important investing update. Your voice matters here. Do you agree with our assessment? See a risk we missed? Drop a comment, thoughtful discussion helps everyone. Now with that said, let's get down to business. The clock is ticking as we move closer to November, and the first company we are going to analyze has been a quiet force in the enterprise world for decades. It's a name you know, but you might not be fully aware of the powerful transformation it has undergone in recent years. This software giant is strengthening its position and preparing for a new era of dominance. Let's get into it now. The first company we're putting under the microscope, Oracle, ticker ORCL. For decades, Oracle has been the backbone of global business, renowned for its impenetrable databases and mission-critical ERP systems. These platforms manage everything from finance, logistics, human resources, for the world's largest organizations. Built on on-prem software, Oracle executed a strategic pivot into cloud services, reshaping its future and creating a compelling investment thesis. Oracle's cloud move wasn't defensive, it was deliberate and aggressive. It built a second-generation cloud platform from the ground up to compete at the highest level, focused on superior performance, strong security, and cost-effectiveness for enterprise-grade workloads. Why buy now? Primary reason, undeniable momentum in its cloud business. Oracle is consistently winning large-scale contracts, displacing incumbents. This isn't just incremental growth, it shows the value proposition is resonating. Cloud expansion, including IaaS and SaaS, is creating a steady, recurring revenue stream. Predictability is prized in investing, and Oracle's cloud delivers it. The narrative has changed, no longer a legacy struggler but a formidable cloud player with runway for growth. Deep relationships with a massive global customer base create a powerful pipeline for cloud migration and upselling. As digital transformation accelerates, Oracle is positioned to capture significant enterprise cloud spend. Oracle operates with impressive profit margins and strong free cash flow. Share buybacks reduce outstanding shares and can lift earnings per share, often a tailwind for the stock over time. Blue chip and public sector clients are sticky. Migrating core systems is risky and costly, reinforcing multi-year contracts. In a sector of lofty multiples, ORCL can present a more grounded entry point for value-conscious investors. Cloud is fiercely competitive with hyperscale rivals. Oracle must keep innovating and executing flawlessly to win share. Broader economic slowdowns can delay large IT projects, potentially moderating near-term growth. Expect volatility. Keep focus on fundamentals and strategy rather than day-to-day noise. The company sits at a market cap of $805.51 billion, generating earnings per share of $4.31, and trading at a P/E ratio of 65.77. For 2024, Oracle booked $52.96 billion in revenue and $10.46 billion in net income. Figures that highlight both the scale of its enterprise footprint and the premium investors are willing to pay for its growth narrative. Bottom line on Oracle, rapid cloud growth, strong and steady cash flow, an incredibly loyal customer base, a disciplined management team. Together, they make Oracle a standout candidate for long-term investors seeking proven models with significant runway. For investors looking for stability plus growth, Oracle looks very attractive to consider right now. Now let's pivot to our second pick, an icon of social connection and digital ads with big ambitions for the future. Before we do that, this video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the course to teach you how to identify great companies, make smart decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to our second company. This one is a dominant force in social media and digital advertising, a name synonymous with our daily online lives. Meta Platforms, trading under the ticker symbol META. Its family of apps reaches billions every day, powered by a highly lucrative digital advertising business with unparalleled reach and precise targeting. From local shops to the world's biggest brands, advertisers rely on these platforms to drive results. After intense scrutiny and strategic realignment, Meta has emerged stronger, leaner, and more focused than ever. Ad revenue is recovering strongly as advertisers return and increase spend to reach its massive user base. Cost control and a year of efficiency are lifting profit margins. Revenue growth plus efficiency equals a strong investor case. More cash flow funds long-term projects while still rewarding shareholders. Recent coverage highlights improved profitability and returning ad growth as central to this thesis. So yeah, that's the core of the case. The sheer scale, billions of daily users, is a moat that's hard to replicate and underpins ad dominance. Aggregated, privacy-safe performance data helps deliver ROI few can match, reinforcing pricing power. More users attract more advertisers, which funds better features and content, which attracts even more users. And beyond today's profits, management is playing the long game with bold, forward-looking investments. Let's talk about that. Meta is pouring billions into reality labs, virtual reality, augmented reality, hardware, and software, high-risk, high-reward bets on the next computing platform. Even if the metaverse is years away, these bets aim to define future interaction and avoid disruption. You get a dominant, cash-rich ad business today and a call option on tomorrow's tech. Meta's market cap stands at $1.86 trillion, with EPS of $27.56 and a P/E ratio of 26.399. In 2024, the company delivered $164.5 billion in revenue and $62.36 billion in net income, reflecting exceptional operating leverage across its family of apps and accelerating AI infrastructure push. After skepticism around spending and regulation, Meta has at times traded at a reasonable P/E versus other large-cap tech growth names. Strong balance sheet, improving profit margins, potentially undervalued price, together a compelling case for consideration. That's the long and short of it. Revenue is tied to digital ads and macro cycles. Downturns can pressure ad budgets, impacting growth. As a major platform, it faces ongoing regulatory scrutiny, data privacy, competition, and content standards. Any new rules limiting data use or targeting could affect operations and profitability. Reality Labs currently runs at large losses. Payoff is uncertain, and timelines are long. Investors need patience and risk tolerance to weather the journey. Bottom line, dominant ad engine plus bold future bets equals current strength with significant optionality. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now, after hearing the case for both companies, which of these two stocks would you buy first? ORCL or Meta, and why? Leave your answer in the comments below. Recap: Oracle, enterprise software and cloud giant, transformation, stability, growth, expanding cloud, strong cash flow, loyal large customers, a blend of value and momentum. Meta Platforms, the undisputed leader in social media and digital advertising, leaner operations, dominant core, and audacious future tech bets. Side by side, Oracle's multiple suggests expectations around cloud and AI-driven expansion, while Meta's lower P/E, despite much larger revenue and earnings, signals a different risk-reward profile. Both are heavyweight plays, but they're riding distinct engines. Oracle on enterprise cloud momentum, Meta on ads at scale and AI-fueled efficiency. If you're enjoying these stock tips and you're ready to level up, I've just relaunched my Value Stocks Investing Master Course, principles used by legends like Warren Buffett and Benjamin Graham. This isn't just theory. Learn to spot undervalued companies, build a high-quality portfolio, and protect your investments. It's packed with step-by-step lessons, powerful insights, and practical strategies. Click the link in the description and pinned comment to join today. Trust me, your future self will thank you. Don't forget to like, share your thoughts in the comments, and subscribe so you don't miss the next important financial investing update. Thanks for watching, and I'll see you in the next one.